Let's be honest, when you first look at the world of trading, it can feel, well, intimidating. You see all these crazy charts, you hear a ton of jargon, and the hype on social media makes it all seem like some exclusive club you're not invited to. But what if I told you it's all just a big misunderstanding? Let's break those walls down and figure this thing out together. Fair value gap, liquidity sweep, market structure shift. You hear these terms and your brain just kind of checks out, right? It's a totally normal feeling. It's like trying to learn a new language, but overnight. But here's the secret. They're not magic spells. A fair value gap? That's just a price imbalance. A liquidity sweep? That's just price grabbing a bunch of orders. And a market structure shift? That's just a fancy way of saying the trend changed. See? They're just concepts, and we're about to make them make sense. So yeah, feeling a little lost? You're definitely not alone. But you know what? It really doesn't have to be this way. We're going to cut right through all that noise, forget the hype, and build a really simple, clear foundation so you can understand how these markets actually work. Okay, before we dive any deeper, we have to get one thing straight. We need to completely redefine what trading is. Forget what you've seen in movies, that high-stakes, heart-pounding gambling stuff. Real trading, it's a business, and it's built on two things: managing your risk and understanding probability. So let's just get this out of the way. Trading is not gambling, it's not guessing, and it is absolutely not a way to get rich quick. What it is a skill you develop over time. It's a business you have to manage properly, and it's all about playing the probabilities. You know, the pros, they're not just chasing money. They're chasing perfect execution of their plan, day after day. Now, this might sound completely backwards, but it is the absolute heart of successful trading. You can be wrong more than you're right and still end up profitable. How is that possible? Well, it's not about predicting the future perfectly. It's about making sure that when you win big, and when you lose small. That's it. So, when you look at a chart, what are all those squiggly lines really telling you? They're not just random noise. They're actually a picture of human emotion on a massive global scale. So to really learn how to read the market, you first have to understand what makes people tick. So what's actually pushing price up and down? It all comes down to these four powerful human emotions: fear, greed, panic, and patience. Every single move you see is driven by these feelings. The market is always trying to find a balance, and it moves to areas where there are tons of orders waiting, orders placed by people acting on these very emotions. And on top of all that emotion, the market has a daily rhythm, a pulse. And here's a tip. Not every hour of the day is good for trading. The Asian session, it's usually pretty quiet, kind of setting the stage. Then London opens up, and boom, price often breaks out. Then New York comes online and either keeps that move going or flips it completely. Knowing when to trade is just as critical as knowing what to trade. Okay, so we get it. Markets are driven by people and by time. But how do we actually see that on a chart? Well, we need a map. And the two most important landmarks on that map are market structure and liquidity. Just think of structure as the market's skeleton and liquidity as its fuel. Let's start with the skeleton, market structure. This is your foundation, your starting point. All it does is tell you which way the market is generally heading. Is it going up? Is it going down? Without knowing that first, any trade you take is frankly just a wild guess. And the best part? It is so simple to see. A bullish market, one that's trending up, just makes a series of higher highs and higher lows. A bearish market, one that's trending down, does the exact opposite, a series of lower highs and lower lows. That's it. That's the skeleton that gives your entire analysis a backbone. All right, now for the fuel, liquidity. I know, it's another one of those fancy words, but all it means is a spot on the chart where a ton of orders are sitting. Think about it. All the places where people put their stop losses to get out of a trade, price is drawn to those areas like a magnet, because that's where the big institutions can get their massive orders filled. So, where do we look for this fuel? Well, it's usually hiding in plain sight. You see two peaks at the exact same price level? That's called equal highs, and you can bet there's a giant pool of orders sitting right above it. Same thing for equal lows. The high and low of the previous day or the previous session, those are also huge magnets for price. So now we have our map, and we know how to read structure and find liquidity. But you know what? A map is totally useless if your car runs out of gas 10 minutes into the trip. This next part is all about survival. It's about risk management.
And I promise you, it is the single most important skill you will ever learn in trading.
Look, a good trade isn't some random click of a button. It's more like a carefully planned ambush. It takes patience and a checklist. First, check the time. Are you in the active London or New York session? Second, does the structure agree with the direction you want to trade? Third, has price already taken out liquidity? And finally, do you have a clear confirmation that the market is ready to go your way? When those four things line up, your chances of success just skyrocket. If you only remember one single thing from this entire explainer, please let it be this number: 1%. Never ever risk more than 1% of your trading account on any single idea. Why? Because the math of losing is brutal. If you lose 50% of your account, you need to make a 100% gain just to get back to where you started. Small losses keep you in the game. Defense wins championships. So these are your non-negotiables. These are the rules to live by. Risk 1 to 2% max, always, and I mean always, use a stop loss. That's how you know exactly how much you stand to lose before you're even in the trade. And if you do take a loss, you get up and you walk away for a bit. You never, ever revenge trade. Breaking these rules is the absolute fastest way to blow up an account. Seriously, just forget about getting rich by next Tuesday. Your first job, your only job as a new trader, is to protect the money you have. Survive. Stay in the game, keep on learning, and I promise you the growth will come. We've covered the technical stuff, the maps and the rules. But all of that is basically useless without this final critical piece of the puzzle. The real battle in trading, it's not you against the market. It's you against the person staring back at you in the mirror. It's all about psychology. You know the difference between a losing trader and a winning one? It's not some secret indicator. It's all about their mindset. Losing traders are reactive. They overtrade, they have a fear of missing out, they let their ego make bad decisions. Winners, they're proactive. They wait patiently for the perfect setup, they journal and learn from their mistakes, and they choose discipline over emotion every single time. The legendary trader George Soros, he got this. He knew the key to making money wasn't about having a perfect win rate. It's all about making sure your wins are much, much bigger than your losses. You've got to cut your losers quickly and let your winners run. And here's another legend, Paul Tudor Jones. And he had built his entire career on this one idea: defense first. Every single day, his primary goal wasn't to make money. It was to protect the money he already had. Shifting your mindset to that is, well, it's a total game changer. And finally, a little wisdom from the master of trading psychology, Mark Douglas. This is such a profound truth. You will never know for sure what's going to happen next in the market. And guess what? That's okay. You don't need to. You just need a plan with an edge and the discipline to follow that plan over and over again, even when you're uncertain. So let's wrap it all up with this one idea. Stop trying to be right on every single trade. It's a battle you're just going to lose. The real goal, the only goal, is to be consistent. Consistent in your process, consistent in your risk management, and consistent in your mindset. If you can do that, you've already won the hardest part of the battle. So the only question left is, are you ready to learn?